interesting and all the rest of it, but this will make you money, all right, which is probably why you're here, I would guess. Certainly why I do this business. So Mind Over Markets is the Bible for volume and market profiling. Thank you. Thank you. It's a very important book. You will almost certainly need to read it a few times and keep referring back to it. There's lots of pretty diagrams and colours, not all text, okay? It's not, right, there's lots of stuff to look at.
Sorry, we don't get to keep this book after.
You don't get to keep this book, you're right, yeah. Mainly because it costs about 50 quid, I think. 70 US dollars. So, however, you do get to, I don't need it back. I want you to read it and have read it by the middle of next week, but you can hang on to it and then keep referring back to it. But you need to read it quickly and get up to speed on the concepts in it, and then hold on to it for reference for the next week or two, okay? Does that make sense? But a very important book with lots of concepts. I expect lots of questions from you. Like, what does he mean when he says da 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 da, whatever it might be, okay? And that's my job to answer them for you. But you need to get up to speed with this stuff, okay? I'm going to be talking about it, he's talking about it, and we are going to talk about it. This is a major, major part of what we do. So, happy reading. Do I mean Tuesday, Wednesday? I expect you to just get on with read it. Yeah, so I'm not going to be specific, but yeah, this is the quicker you can get it read, the more you'll learn. Trust me. Okay, and then you need to refer to it. But yeah, okay, let's say Wednesday. But you know, it's not school. I'm not going to hold it to you. Hey? You have to have a plan. Okay, well that's a good idea. So always have a plan. There's 300 and let's have a look. There's 344 pages by the look of it. Divide it by 5 and away you go. Okay, 109 pages a day. It's not 109 pages, is it? Not for 5 days. It's no. Okay. Not even that many, is it?
Just.
6 is into 6 goes for There you go. 69 pages a day. There you go.
Is there any way to practice the concepts while reading it?
Yes, because we'll be looking at these charts every day. So yes.
Like have these charts at home so we can.
Well, you can go online at the moment. At the moment, we don't give you charts for another couple of weeks or so because we don't want you getting sidetracked and we want you looking at this stuff. But if you go online, there are some basic market profile charts to look at. If you go to Market Delta website, I think they give you some free example charts, not live charts. There's all sorts of resources on the internet, so I suggest you have a look on the internet under market profile and you will find plenty of stuff. I'm not going to recommend or any specific ones, but there's plenty. Okay, so yeah, by all means have a look, and then we can talk about it each day as well. Okay. So let's just take a quick look at how we form our profile and what all the various different things mean. I feel lost. I actually put that pen down. There it is. Okay. So this is a profile. The reason why you might notice we always start with a small letter K. Small letter K represents 7 o'clock till 7:30 a.m. European time, mainly because capital letter A starts off the US trading day, and this is the way it works. By the time you've gone all the way through the capital letters and then you get onto the lowercase letters, letter K, trust me, represents 7 to 7:30 a.m. So when we set up our charts so that everyone's looking at the same letters and we can talk about the same things, 7 to 7:30 a.m. UK time is the letter K, except when we're in clock change time, but we'll worry about that some other time. So what we've got here is our first hour of trading. We've got all our Ks and we've got all our Ls. So the top of this blue line here is the initial balance high. And what does the initial balance represent? First 1 hour of trading, i.e. the first 2 letters. Okay, so the first 1 hour of trading, that blue line is the initial balance high. The next thing is the O. Someone did ask, what does the O represent? O for open. So it's the opening price print, so that we don't have to search through later in the day. Where was the open? It's there. It shows us all the time. The highlight in red, both the letter and the price, is the last traded price. So we don't have to worry about looking for a cursor or anything like that. It's highlighted for us in a colour. It shows us what price it is. This red horizontal line volume is the volume point of control. So that represents the volume point of control, where the most volume has traded. And then the bottom of the blue line is the initial balance low. Okay. Any questions? All right. So this is sort of moving on and developing. This is a series of daily charts. So the green TPOs, trading price opportunities, is our value area. The orange is our volume value area. And you can see they're not the same. They're similar most of the time, but they're not the same. The greens trade up here at 74, the top of the volume is 72. And likewise, so the actual value area is outside on the time compared to the volume. The midpoint is represented by this white cursor on the left-hand side. So to save you trying to work out where the middle of this range is, it's always represented for you and it's shown there. The volume point of control is our red line. What does the asterisk mean? What do you think the asterisk means?
Current price.
Okay, but this is an old day. So this is the real day. So what's the asterisk? Close. It's a close. It is. It's a close. Exactly. So it's a last traded price, and in that case, the last traded price on an old day is a close. Simple as that. Okay. The other thing we've done here is we've split the morning profile and the afternoon profile. So this represents the morning, the European morning, and this represents the afternoon or the US trading session. 2 different sessions. Any questions on anything on there? You'll be getting a market profile test in a few days, so feel free to ask questions. Okay. So this is a full day's market profile, putting everything together. So, what is significant about this price here, 71s?
It's the middle.
It's the middle, yeah.
And it's also the VPOC.
This is also the volume point of control, very good. And what does that tell us?
Highest value.
It's very
Yeah.
symmetrical.
But it's quite a balanced sort of day. If you just looked at this, you'd say, well, if the volume point of control is exactly the same as the mathematical midpoint, indicating that the buyers and sellers always sort of returned, no matter what went on during the day, they all sort of returned back to this zone here, okay, that midpoint. So quite balanced. Sellers had a go, buyers had a go. Ultimately, we always kept on returning back to here. So a balanced type day. Value area, roughly the same. It doesn't look like a bell curve. I mean, it's a bit sort of all over the shop. What else is there, though, that makes us a bit wary about calling this a balanced day? Anyone see anything that makes you think, maybe not?
The bottom is it has a higher time than the top.
That's true. That is correct. What else? There's something a bit more significant. There is, but there's something very, very worrying about something on that chart.
People try to push the price up unfairly.
Right.
The higher prices they
quite high volume.
Okay. Anything else?
Where is the close? The asterisk over there.
Okay, yeah. Okay, so where was the close?
Below the low.
Below, yeah.
The actual low of the day was the close. What does that imply?
Tomorrow, so that the price is going to keep going down.
So if the market had remained open and not shut due to some artificial constraint such as time, the market would have kept going lower. Okay, if the market had actually been 24 hours, we would expect the market to have gone lower and lower. So although during the day we were in balance most of the day, the close is like a massive warning sign. Okay, because if they hadn't closed just because it happened to be 9 o'clock at night, suppose the close had been 11 o'clock at night or something, it implies that the prices would have kept going lower and it would no longer have been a balanced day.
Sorry, how do you know where the close is? The red little thing.
How do I
How
know?
do you know where the close is?
So the close is represented by the asterisk, the red asterisk. Can you see the red asterisk?
Oh, yeah.
Okay, so the red asterisk is the close of the day.
Yeah.
It's the last traded price on an active day, but on a day that's finished, that's the close. So it represents the last traded price.
Why is the price of 63 highlighted in red?
Okay, so this is in the final. So the 63s, this is the time point of control.
Okay.
So what we call a TPOC. So if we were just looking at market profile on its own, that would be our point of control, our time point of control. It's the price where we spent the most time, as opposed to the VPOC, which is the price where we traded the most volume. And what is significant about that TPOC? What is perhaps a little surprising? Very low volume, yeah. I mean, it's spent a long time at 63. It's traded, what, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 trading price opportunities. That's 7.5 hours. So for 7.5 hours, we've always been returning to 63, but look, the volume's tiny, really. Okay, you'd expect to have done a lot more volume, so that's interesting. It's something that we need to be aware of. Okay.
What's the purple line?
What's the purple line? Where are we?
46.
This one.
No, 46.
Oh, down here. So, okay, whenever we leave intraday single prints, this I have my computer designed to show us single prints. So I don't have to look back. It puts in a purple line for me to show where the single print started.
Okay.
So, because these are single prints, it shows me where the single prints are. Say again.
What's the thing you just mentioned? The purple line represents?
So the purple line represents these intraday single prints.
What's that?
So, well, they are. Okay, let's go back. If we go back. So when I was showing you this chart here we are. These are intraday single prints, so it's an aggressive breakout either to the upside or the downside. Okay, so we get buyers up here, and it puts in that purple line representing where the single prints are left. So now we're putting in, this is 1, 2, 3, 4, 5 days worth of data. And there's a few things. So if we look at this day here, first thing to note is, where does it open? So the low of the day, and what happens? We get an immediate reaction in the market. So representing what we describe as an opening drive. And an opening drive is simply where the market opens at one extreme or another and rejects that price immediately and never is able to go back and retest it. So on this day here, we get an opening aggressive buy. The market expands. Note the blue, that tells us our first hour's trade, these two prices here. And then what happens afterwards is that we basically then, if you ignored what happened in that first half hour, 45 minutes or so, we then basically get a really nice balanced day. You see that? Yes,
What is the teal color right above the blue bar?
1 second, sorry. Let's get the right screen up. This one.
Yeah.
Yeah, that is okay. Basically, it gives us it shows us where the 50% extension of the initial balance is. You don't have to have that. It just happens that this computer was set like that. But basically, you can represent. So if I go,
So that's 1 hour and then 1 hour.
so if I bring this in, and I go for preferences and price levels, so I can have it's shown on green on this one. But basically it's 150% of the initial balance. So it just represents where is a 50% extension of the balance and where is a 100% extension of the balance. Some people use it, some people don't. It just happens that whenever this one was done, that's how it was set up. Just been asked a question. If not a balanced day, given the close below the open, would the probability of gapping low on the following day's open be high? Yes, extremely. The answer to that one. So a couple of things to note is that the close was below the point of control. So even though it appears that the buyers are in control, the close was relatively weak. Normally, if you're going to have a strong market, you'd expect, so if you have a big up day, you'd expect the buyers to be in control and be able to close the market at quite a high price. Certainly above the price where all the buyers and sellers agreed at one time or another, where fair value was. In this case, it didn't. So a little bit of a warning sign. The other thing is that we've got a selling tail up here, indicating that sellers are present. So the next day we open roughly where we closed. You see we closed here and we open here. We spend the vast majority of the day in balance, and then towards the end of the day, as you can see, we actually reject everything that happened on that opening drive and we close right down here. Our open, our time point of control and our volume point of control are all roughly in the same area, and the midpoint is actually right down here because of this late sell-off. The next day we open higher. We test down to the previous day's close without being able to take out the low, and we then rally back, and basically we're just traversing. You can see on these 3 days we're really just doing the same sort of thing. It's the same sort of area. Point of control, point of control, point of control. Okay, close, close and close. So that was a weak day, but because it wasn't able to take it out, we bounced back and we're up here. And so overall, we're basically building a picture whereby buyers and sellers, broadly speaking, between this price and this price, and this is where all the action's going on for most of the day, for 3 days on the trot. The next day, so we've closed here, the next day we open here, and then we test higher and lower. We keep doing, all morning, we're doing this, just repeating these prices here, and then eventually we break out. I don't know where that goes, but obviously goes up much, much higher. And then over here we get a buying tail the next day when we're down here. Any questions? Okay. So these are examples of what we call weak highs. So what do we mean by a weak high?
It got tested several times.
Sorry?
It got tested several times.
Okay. So what does that mean though in terms of buyers and sellers? What's actually going on?
Buyers trying to push up the price.
Yeah, and what are the sellers doing?
Push down the sell side.
Yeah, but they're not pushing back. What they're doing is they're just sat at that price. They're just saying, okay, we're here. Normally when you get to a high, so people buy a market up or buy any product you like up, gets to a price and sellers go, no, that's wrong, it should be back down here. In this case, people are buying the market up, but the sellers are just sat there going, you can buy as many as you like, but we're just going to sell here. We're not going to sell lower, we're just sat here. We're happy to sit here. So people come up, they start to buy off these sellers, they realise there's more sellers than they can buy off, so the price gap comes back down a little bit. Then they have another go later in the day, trot, up they go, up to this price. Sellers are still there, they can't break through, market backs off a bit, all those people who bought get out of their position. Then later on in the day they have another go. And so these are sellers, but they're passive. They're not aggressive. They're passive sellers. And it's important to understand the difference between the passive selling and aggressive selling. So on this day, we have passive selling. And the market even closes pretty much on the high as well. So the buyers have not managed to break through. The following day they break higher, but then what happens up here is we get aggressive selling. So the market comes up and the prices are rejected. So the sellers not only are sat there, they're going, you know, not only that, it should be down here, guys. You're in the wrong price. The wrong price is trading. And then next time, come up here and we have a weak high again. Lots and lots of trading at the high of the day without being able to break through. And the significance of these weak highs, or weak lows, depending on what, in that case, there's a weak low and a weak high. So just a generally very strange sort of day. The significant is you expect them to be taken out in the near future. You don't expect those prices to hold. If you've got aggressive selling, then you expect those guys to be aggressive next time. But if you've got passive selling or passive buying, you expect them to be passive next time and be taken out. It's not a guarantee, but it's just something that part of the filter that we use when we're trying to work out where is support, where is resistance. That's all we want to know. Because if we can identify where support is, if we know where all the buyers are, we can buy as well. And if we know where the sellers are, we can sell as well. That's our job. We are looking to find support and to buy it, and we're looking to find resistance and sell it. That's our sole job. That's the only thing you do. If someone says to you, what do you do for a living? That's what you do. You're looking to identify support and looking to identify resistance. Everything else is just garbage. That's all you're doing. You want to know where do people want to buy something and where do people want to sell something. And wherever they sell it, you want to be selling. Wherever they buy it, you want to be buying. That's the whole point. You want to be on the winning side. It's a battle going on, lots and lots of little battles all day long. Your job is to pick the winning side. There's no point in you thinking to yourself, well, I think there are loads of sellers here, and so you join in, but you've misidentified where the sellers are. There aren't sellers there at all. The sellers are all up here. Too late for you. You've got to work out where the buyers are, where the sellers are. Give it a reasonable approximation in your mind of the likelihood of that being the case and working. And we need clues. We need technical analysis. We need fundamental analysis. We need to understand what's going on the ladder. We need to understand the context of the day, of the week. Where are we? What's going on? What product are we trading? What's moving it? All these things are going into basically the one thing we want to know. Where are the buyers? Where are the sellers? Where's support? Where's resistance? That's your only job. Everything else is just complicating it. Okay? So this is a weekly market profile. I said earlier I wasn't going to. So what you can also do on the profile is we can just put the whole week together. So we put all 5 days together and make it into one profile. So each of these represents 1 week, and you can see that we have multiple profiles within a week. So you might have a balance area down here, another balance area here, a little one there, and sort of a bit of a tail up here. And this represents all the TPOs, and this represents all the volume. So over here you can see basically we had nice balance here and then a second distribution here. And then on this day, on this week, we've had balance up here, another balance here, another balance here. Yes?
What happens between
What, these places?
yeah, are those
So these are breakout areas. So basically what's going on, if we try and draw that. So we got okay, so these areas here, so we're in balance here, all this is balance, okay, that's what we're expecting, and then something happens, and we don't know what it is, but whatever it is, it tips the market out of balance into imbalance, which basically means that at this stage, if we were looking at it here, everyone agreed this was fair value. This is where buyers and sellers were happy to trade, and they were doing this, and they kept on coming back to this price in green. Something changed, as it does. whether it's a piece of economic news, whether it's a piece of something that makes the buyers and sellers suddenly no longer agree that this is the right price. And in this case, there must have been sellers come into the market, and it then became a case that this price here became the price over a period of time where buyers and sellers agreed. And this represents whenever that news broke, whatever it might have been, whatever caused that to happen from there to there, it didn't spend very long. The sellers overwhelmed all the buyers. So there were buyers here happy to pay this price, and the sellers were matching them. All of a sudden, for whatever reason, the sellers overwhelm the buyers and they take the market down, and then the buyers start coming in and trading around here. And this represents that sort of when that news broke, the buyers run for cover and the sellers are overwhelmed. You think of it like an army sort of sweeping across the board, and they've taken over the next trench and moving on. And that's how I think of the markets. Buyers and sellers, just medieval battle, fighting each other, and that's what they are. They're all busy, taking a bit of land here, taking a bit of land there, but that's what's happening. They're sweeping over them and taking over, and then later on, still, same thing happened. Sellers overwhelm the buyers, and we get a different price for fair value. And it's changing all the time, and that's what's going on with trading. So buyers and sellers are matching up the whole time. And it doesn't matter what you're trading. It could be apples, could be bananas, could be these mind over market books, which what are they? $80 odd. So $70. So one day this will go out of fashion, and there'll be 1 million of these on offer on Amazon second thing, and everyone will go, well, this is garbage now. We don't follow it because we're following the latest new thing, etc. And the price of it will plummet because the buyers won't be there. But at the moment, everyone's happy to pay $70 for it, because why wouldn't you pay $70 for something that's going to make you a few $100,000, etc. But this is going on the whole time. But as we we can put together a month, we can put together 2 months. But what we can see from this is that over a period of time, so here was our midpoint and here is our volume point of control on this week. But we closed down here. The next week, our volume point of control was below the previous week, and we actually made new lows. We went below this week, and then we get another week. So you can see that gradually the market is coming off, and you can sort of see that, and this represents 3 weeks of data, so 15 days of data.
What's the orange bar there?
So the orange is just the volume value.
The vertical orange bar.
Vertical orange bar.
In the middle.
Oh yeah. It will be a setting which represents the well, no, that's the value area. That's probably the initial balance,
Okay.
I would think. I mean, it depends on whenever this print was taken,
So
on
it's
what
about
the
the
settings
same.
were. I wouldn't worry about it.
Okay.
It's not really relevant, to be honest. I would guess it would be the weekly equivalent of initial balance for the first 2 days, but I'm not sure. So, what are markets trying to do? And I think again, this is some of the key points of what we're trying to do. Markets seek balance. Buyers are looking for sellers, and sellers are looking for buyers. If you're a buyer and you don't have a seller, you can't do anything. If I'm selling my house, I need a buyer. Okay, so I'm always looking for a buyer. I need to try and pitch my house at a price where there are buyers. And likewise, if you're buying a house, you need to be paying up to the price where there are sellers for that house. So markets are always looking for balance, and as such, it's an acceptance of fair value. This is what the consensus is that product is worth today, at this, well, not even today, at this precise moment. And that can change at any one time. It can always change. We can always get new information, and that will change the buyer's perception of where fair value is and the seller's perception of where fair value is. So if we know where balance is and we know where fair value is, if the price moves away from that, we can anticipate that, okay, it should come back. Hence, if you know over here that this is fair value, this is our high volume node and our volume point of control. So if the market comes up here, what are we going to do? Sell. Exactly. Because we know, or we think we know, that the market should come back down to our point of control. Yes, Janesh?
Do you have to also like understand like that move going up is not because of some other external
Exactly.
thing?
So you have to ask yourself, why are we up here? Is it because we've had some new information? Is it because there's some economic news out, etc.? You have to know the context. That's why, on my favourite little chart with all the things that go into deciding why we're putting a trade on, our price action filter. It's not just about this. It's not just about this. This is part of it, but there's so many other things. Not least of which is your own psychology and your bias as human beings, which you will have. So lots and lots of things go into it, but if we're looking at purely in terms of there is nothing new happened, the world is calm, nothing else is going on, everything's fine, but prices have drifted up here, we would expect it to come back again. Likewise, when it drifts back down here, we expect it to come back again because markets are looking for balance. That's what they're trying to do, find an acceptance of value. So the three ways that we measure that balance are the volume point of control, the balance point, which is basically the time point of control, and then something called the VWAP, which is a favoured measure for modern day algorithms and electronic trading. Does anyone know what the VWAP is?
Volume weighted average price?
Yes, exactly what it is. Good. So it's a volume weighted average price. So volume weighted average price. This is the measure that algorithms use a great deal. So if I bring back what I want to do, remember this chart here. So this purple line, oh no it doesn't, the blue line, no, okay, maybe it's not even on here. Okay, I'm going to add the VWAP, which is over here, VWAP, and we'll leave it that colour for now. Where did that go? Okay, so this bright green line, so it's not very clear on there, is it? See if I can make it stand out a bit. Okay, so this dark green line now represents the volume weighted average price. It's not something that you can work out in your head. Okay, because it's obviously changing a great deal the whole time. But this is favoured by algorithms. If you think about it, when you give an order, if you're an end user of a product and you say, okay, today I need to buy 1,000 potatoes, for the sake of argument, okay, and I want to get a fair price for whatever the potato is trading today. I want the middle price. The volume weighted average price will give me a fair price of whatever price potatoes are traded today. So over the course of the day, you want to buy a couple of potatoes here, a couple of potatoes there, and so you've got all day long, you've got 12 hours if you like to buy your 1,000 potatoes. You want to get a fair price. You don't want to pay the high, you don't want to pay the low, you want to pay somewhere in the middle. So you keep trading at the volume weighted average price, and brokers in general, nowadays modern orders go in and people want to buy a large quantity of something. They want to get the fair price, so they try and get in at the volume weighted average price, and it acts as a good support and resistance measure, and we use that, the volume weighted average price. I know it's not on the profile, but it's important to understand that this is a third way of measuring balance. That is where the balance is. Okay. So that's our third measure of balance. When all of these things line up, it tells us that the market is in perfect balance. And what's likely to happen when the market is in perfect balance?
Boring.
Yes. So, but what's the next phase?
Something come out.
So eventually something's going to give. So the buyers and the sellers are going to batter each other away, and eventually, even if you're only killing one soldier at a time, eventually someone's going to run out of soldiers. Okay, and they're going to get overrun. The buyers are going to overrun the sellers are going to overrun the buyers. It's unusual, certainly in modern markets, for a market to remain in perfect balance for any great length of time. So once it's done that and finished that, the thing to look for next is imbalance. And you need to look for the next catalyst that's going to come along and give us that move. So, when a market moves out of balance, it auctions away from the previous point of control as it looks to find the new accepted value. So, for example here is our point of control, and then it moves out of balance down to our next. That's what it's searching out. What's our next point of control? Where are we heading? And that's the next price where the buyers and sellers are happy to match up. So whenever we find value, look for the next move, and the thing, what all this represents is this is the next point where the buyers and sellers agree on price. And what we do know is that previously the sellers overwhelmed the buyers, so it's quite likely that eventually the sellers will overwhelm the buyers again. Why wouldn't they? Otherwise we're just going to keep going back and oscillate between these two. Sometimes that can happen. So point of control, always looking for it. So what are our key market metrics? So our key market metrics are our opens, our highs, our lows, our closes, our single prints, our buying tails, our selling tails, our weak highs, our weak lows, our midpoints. All these things, every single day we start to record this stuff. Once we start to get charts in a couple of weeks' time, we're going to be doing this every single day. Okay, we're going to build up a pattern. We're going to see if we can see patterns and use it to help us to predict where the buyers and where the sellers are. Okay. So, where is fair value or balance? I mean, all these terms are, we sort of throw them around and we use different phrases, but they all mean the same thing. So where is fair value by time frame? Where is fair value today? Where was it this week? Where was it last week? Where is it for the month? Where is it on the year? All these things matter. Where is fair value for the last 10 minutes? What's going on? That's what we're looking for. If we know where fair value is, and we know the time frame we're talking about, we know then when price has moved away from that, and therefore whether or not it's likely to come back again. Who's in control of the market? So are the buyers in control? Are the sellers in control? Who's running the show? You can have temporary slowdowns where the buyers sort of slow the sellers down a bit, but the sellers are ultimately always in control. And that could be, could have been for the last 6 months, could have been for the last month. I mean, take the S&P at the moment. Who's in control of the S&P? Anyone like to have a stab at that? Okay. Why would sellers be in control?
Because it drops.
But it's on pretty much on contract highs, record highs. Overall, the S&P is on. US stocks are overall on pretty much on their highs, so buyers are in control. Over a period of time, over time, at the moment, the buyers are always in control, and it's the same. Okay, German government bonds, record low yields, record high prices. Again, Buyers are in control. They have been for the last 5 or 6 years. So on a 5 to 6 year say, you say buyers are in control. If you take 5 or 6 months, buyers are in control. If you take 5 or 6 days, sometimes it'll be buyers, sometimes it'll be sellers. But overall, in the long, bigger picture, buyers are in control. And that's a very important thing to understand and know.
Could the government, the government could well be in like assessing which levels they want the market to be in, right? It can't. Like for example, the Chinese.
Well, not the government. Well, in theory, governments don't do it. Central banks do, and it depends on how independent you think your central banks are. But yes, go on.
Yeah, no, I'm just saying. Yeah, I was just thinking. Like,
So at the moment, okay, so this is one of the points. So we've got a distorted bond market at the moment with QE and the fact that central banks buy their own government's bonds. It gives a distorted view of the market. So
how
normally,
distorted is distorted?
well, that is a debate that you can have for
Okay.
as long as you want, and if you read the Wall Street Journal or the FT, etc., or the letters pages, that's one of the big disputes. How distorted is distorted? How far away from reality are current prices? Prices were purely based on speculators and end users coming together and agreeing on a price and matching and finding balance. Fine, that is normally what happens with a market. Okay, you get people decide it's worth that, other people say no, it's worth less, etc. Eventually you get to this point. But at the moment we've got these governments, in the case of the ECB, who are buyers only of 80 billion euros worth per month. That's a lot of money by anyone's book. And so you've got a distorted market. You have a market that is bid. So people who know, so we know 80 billion euros are going to be bought every day. So why don't you buy as well? So it distorts the way investors look at the market. They don't look at it in terms of why would you sell when you know that there's someone buying 80 billion euros worth every single day, every single month, and it distorts the market. It definitely has an effect, and this is one of the problems. So if you read the press and keep up with the press, and it's the same in the US market as well. People are saying that because interest rates are held artificially low because of QE. The investment, past investment in the Fed, also in government bonds, the market is distorted. Because really, if the central banks weren't buying, those buyers wouldn't be there. It's like an artificial prop under the market. Yes, Richard?
Why is that a distortion? Because the central bank could be just want to buy in the market, like any other buyer is free to buy in the market.
Okay.
Why that distortion?
What is the central bank's role really?
Control inflation.
Well, it depends which. Yeah, okay, both of those. Yeah, depending on the central bank, you're right for both of them. But historically, central banks have not bought their own government bonds because they're not an end user. They're not a genuine end user. So why do people buy government bonds? Well, because they want a product that's going to pay them an interest rate. Usually, they want a safe product that they know they're going to be repaid. If it's a German bond, slightly different if you're talking about a Zimbabwe bond, but there's a reason why the prices are different. But people are end users, and it's based on interest rates, and it's all that sort of stuff. But there is no reason for a central bank to come in. Where does the central bank get that 80 billion from that they are doing? They print it. What effect does that have on the currency? It devalues. So all of this is having an effect on the economy. They're not genuine end users, because normally if someone came along, if I wanted to buy 80 billion euros worth of bonds, I wouldn't be able to print the money to do it. I'd have to have the money, and it wouldn't affect the currency. It wouldn't dilute the value of the currency that I'm using. And it wouldn't affect the balance sheet of the central bank either, which it is also doing. So that central bank balance sheet, irrelevant of whether the central bank is independent or not, effectively is underwritten by the people of that country. Okay, even though it might be considered technically not to be the case because it's an independent central bank, in reality it's underwritten by the people. So it comes out of their pocket eventually, and it affects them. So that 80 billion is just, we've all paid a euro cent, I expect, or something like that. Maybe 5 euro cents it's cost us as individuals. But this is why it does matter. This is why they're not genuine end users, and their job is not to buy a 10-year bond and then sit on it for 10 years and then it expires and they get rid of it, but they've still printed that money. They've still diluted their currency to do it. And that, for that reason, I would argue, I'm sure if you spoke to, I'm sure there are central bankers who make other arguments, but that's the argument that traders will make about the whole thing. Okay. So who's in control? Where are the extremes and how did they trade? Do apologies, sorry, I'll just. Okay. Where are the extremes and how did they trade? So again, we want to know where did the price get to where the sellers came in and decisively rejected it? Where did the market go down to that the buyers came in and said, my God, that's so cheap, I've just got to have as many of those as I possibly can. And that tells us, you know, that gives us sort of an envelope, if you like, of opportunity. And there's no reason to assume that if nothing else changes and we don't get fresh information, why those prices aren't going to hold in the future. And that's what we're looking for, that's what we're trying to find out. Also, not only that, at the extremes, things we're interested in is what time of day did it happen? So was it in the middle of the day, was it at the end of the day, was it at the start of the day? And how much volume went through? So how aggressive were those sellers? So maybe the buyers were just busy, happily buying, and suddenly they get hit by a tsunami of sellers all at the same time and get heavily rejected with heavy volume. Or maybe, you know, there was just no one really much trading, very, very light volumes coming up, very, very light volumes also able to take it down. So perhaps not as strong as selling as you might have expected. All these things matter. And then where are we looking for the profile to extend to? And the way we do that is by looking back. So if we take, so if we look at, we want to look back and see what's been going on the last few days. So if we're coming down here, so for example in this market, the price is coming down, where do you think you might find some buyers? If the market keeps coming down here, where do you think you might find some buyers? And why?
30?
The previous high volume.
Say again, sir?
The previous high VPOC.
Okay, good. So I think this price here, 34, 35, for three reasons actually. So the first reason is that yesterday, this is the price where the buyers and sellers agreed was fair value. There's no reason to think at the moment, I'm assuming there's been no fresh news, which it doesn't look like it, why the buyers won't make a stand there again. Why would they were happy to buy it there yesterday, why wouldn't they buy it there today if it comes down? Secondly, it was clearly balanced, it was both the open and the closing price as well, so that implies as well that anyone who was, so if this was a close, anyone who had a position overnight was marked to that price. So if it comes back down to that price, they're probably happy to take that price again today. So for those reasons, I think it's highly likely. Not only that, if you go back the day before, this is where those single prints were as well. So this sort of 33 to 36 area is pretty significant and quite important. And should we come down, that's the area where, that's the first area where I'll be looking to put something on, or at least cover my shorts or put something on. Okay, questions? Do you understand the principle of what we're looking at? Okay, the jargon will come. Okay, the jargon's just jargon, that's all it is, but it'll come. Yes, Richard?
Does it always take like an event to break any?
No, it doesn't. No, because you can get. So what might happen is, okay, we're trading, buyers and sellers are all happy. All of a sudden, a pension fund has been having a meeting of all their partners, and they decide they're going to change their allocation of bonds to stocks by 0.5%. It doesn't sound much, but basically what it means is they decide they're going to buy an extra 20 billion worth of bonds and sell 20 billion worth of shares. So a very large order, an institutional order comes into the market. Okay, so the buyers and sellers have all been happy. Now an institutional buyer comes into the market, a long-term trader, someone who's going to You know, they're not interested in getting out of their position after a few days. They're in it for a long time. They come in, they start accumulating whatever it is they're trying to buy, and gradually they overwhelm the sellers that are there and take the price higher because that's what they want to do. Their price sensitivity is far less than yours or mine because they're looking at it from a point of view of a few years. We're looking at it from a point of view of a few minutes/hours. So no, it doesn't have to be an event at all. Yes?
Do we use the ladder to work out if these big guys are
You can,
coming?
yes, okay, so I mean, in real time we would end up using something called a footprint chart, which we will look at in a couple of weeks, to gauge whether or not there is aggressive buying or selling going on, how much buying and selling is really going on. So price might be moving, but how much buying and selling is really going through. And so yes, we use a ladder and we use a footprint chart at the same time to sort of specifically see what's going on. But you can see, if you watch the ladder and you're an experienced ladder trader, you can start to detect when there's a big, you know, what happens is that bids keep getting reloaded, or every time they sell it down a couple of prices, the bids come in and take it up a bit more. You can just tell when there's sort of aggressive activity going through, and it's sort of, again, it's ladder time and it's experience and time. That's how it works. Okay. Any other questions? I mean, we're going to be coming back and back and back and back until you say, "Shut up, John, please."
So are we also gonna receive the charts?
In a couple of weeks' time. Yeah, you don't get I mean, as I think I said on day one, you know, and I take you back to this. You know, charts is one of these circles. I don't know which one it is, but it's one of those circles. That's
No,
all.
sorry, I mean the press letters. Are we gonna receive the press letter by email today?
The price ladder.
Yeah, it's the one you just showed us.
Well, all the slides I've just shown you,
Oh.
you will see. Yes. Yeah, I will be sending them out. Yes, absolutely. Sorry. Yeah. Anything else? Okay. What's the time? 12:05. I'm doing the fundamental stream again at 12:55. So if you could be back here for sort of 12:50ish, watch the stream again, and then we'll come in here and we're mostly going to be doing different contract specs today, this afternoon, okay, and running over different types of contracts that we have. If you think of any questions on this, or you start flicking through the book at lunchtime, you've got questions, we'll do that as well in the afternoon, okay. So if you could sort of be back here for 12:50, ready for watch the stream at 12:55. I don't know if you found any decent places for lunch yet. Wasabi's good, yeah, that is good. There's the non-chain place that is quite good if you just want a sandwich, but it's a non-chain. Is that Paul? It's called, which is just up the top of the road on the other side, about 20 yards down towards St Paul's. That's really nice for run by a French couple. Very nice. Okay. Obviously the best food. Okay. Enjoy your lunch.
Oh, would you like the book back?
Say again?
Would you like the book back?
I would love the book back, please. Yeah, that'd be very nice.